Welcome back, navigators. Today we will oppose traditional investing to the new crypto mania. This is the world of investments, a realm where the future of your wealth hangs in the balance. This landscape is filled with traditional avenues of wealth accumulation such as stocks, bonds, real estate and commodities. Each of these plays a significant role in the global economy, serving as the backbone of many a fortune. Stocks, the shares of companies, bonds, the debt of entities, real estate, the ownership of physical property and commodities, the raw materials that fuel our world, all have their unique allure and risks. Yet, there's a new player in town, disrupting the status quo: cryptocurrencies. These digital assets, independent of any central bank, are carving out a niche in the investment landscape, promising potential for significant returns. Are you ready to explore the pros and cons of these two types of investments? Let's dive in. Let's start with traditional investments, the usual suspects in wealth generation. These are your stocks, your bonds, your real estate, and your mutual funds. They have a long history of building wealth over time and rewarding patient investors. They offer stability, often providing a steady stream of income over the years. These are investments that are regulated, offering a certain level of security and protection for investors. Historically speaking, traditional investments have shown strong performance. They have weathered numerous economic storms and have come out the other side stronger. They offer diversification, allowing you to spread your risk across different asset classes, sectors, and geographical locations. Now, traditional investments are not without their downsides. One of the major cons is their susceptibility to economic downturns. When the economy takes a hit, so too do these investments. And while they tend to recover over time, these downturns can create periods of financial stress for investors. Inflation is another con. The value of your investments can be eroded over time by inflation, reducing your purchasing power. This is particularly a concern with fixed income investments such as bonds. Finally, there's the lack of control. With traditional investments, you're often at the mercy of the markets, fund managers, and other factors outside of your control. You can't directly influence the performance of a stock or a mutual fund, and you're often reliant on others to manage your investments effectively. So, there you have it. In a nutshell, traditional investments offer stability, regulation, and historical performance, but they're also susceptible to economic downturns, inflation, and a lack of individual control. It's a mixed bag with both rewards and risks. Traditional investments have their strengths and weaknesses, but how do they stack up against the new kid on the block, cryptocurrencies? And here they are, cryptocurrencies, the digital disruptors of the financial world. These innovative assets are reshaping the way we think about money, wealth, and investment. But let's not get ahead of ourselves. It's important to understand both the advantages and drawbacks of this new form of investment. Let's start with the pros. The potential for high returns is one of the most enticing aspects of cryptocurrencies. Some early adopters have seen their investments skyrocket in value, turning modest sums into mind-boggling fortunes. You don't need to be a Wall Street titan to invest in these digital assets. They're accessible to anyone with an internet connection. This democratization of investment is a game changer, breaking down barriers and opening up opportunities for the masses. Cryptocurrencies are also decentralized, meaning they're not controlled by any government or financial institution. This gives investors a level of autonomy and freedom that's not typically found in traditional investments. But as with any investment, cryptocurrencies come with their fair share of cons. The most glaring is their volatility. The value of cryptocurrencies can fluctuate wildly, often within a single day. This can be a double-edged sword, bringing both potential for high returns and high risks. Another drawback is the lack of regulation. While this can be seen as a pro for some, it also means there's less protection for investors. If a cryptocurrency company goes under or is a victim of fraud, there's often little recourse for those who've lost money. And then there's the risk of cyber theft. Digital wallets can be hacked, and once your cryptocurrency is stolen, it's virtually impossible to get it back. This risk can be mitigated with proper security measures, but it's still a concern that shouldn't be overlooked. Cryptocurrencies offer a new, exciting way to invest, but they also come with their own set of risks and rewards. It's essential to do your own research, understand the risks involved, and make informed decisions about your financial future. Your own hard-earned money is at play. So, traditional investments or cryptocurrencies, where should you put your money? It's the question on everyone's mind, isn't it? Well, let's dive into this head first. When it comes to investing, there's never a one-size-fits-all answer. Your financial situation and goals are as unique as you are. Let's start with traditional investments. Stocks, bonds, real estate and the like. These are time-tested with historical data to back up their performance. They're typically less volatile and can provide steady returns over time. They're also regulated, which can provide a sense of security. But, like anything in life, they're not without their risks. Market downturns, inflation and changes in interest rates can all impact the value of these investments. Now let's switch gears and talk about cryptocurrencies. They're digital, decentralized and disruptive. They've shown phenomenal growth and offer the potential for high returns. But with high reward comes high risk. Cryptocurrencies are notoriously volatile. Their value can skyrocket or plummet in a matter of minutes. They're also less regulated, which can be a double-edged sword. It offers freedom, but also less protection. So, how do you decide where to put your money? Well, it all comes down to three key factors: diversification, risk tolerance, and investment goals. Diversification is about spreading your investments across different types of assets to reduce risk. Don't put all your eggs in one basket, as the saying goes. Risk tolerance is your ability to withstand losses. If the thought of your investment losing half its value overnight keeps you up, then high-risk assets like cryptocurrencies might not be for you. Finally, your investment goals. Are you saving for a house, retirement, or perhaps a world tour? The time frame and the amount you need will greatly influence your investment choices. In the end, the choice between traditional and crypto investments comes down to your individual financial goals, risk tolerance, and investment strategy. The best investment strategy is one that aligns with your personal situation and financial goals. Remember, investing isn't about getting rich quick, it's about building wealth over time. Now that we've explored both sides of the investment coin, it's your turn to weigh in. This journey we've embarked upon today is not one to be traveled alone. It's a shared experience, a collective endeavor. So let's make this a dialogue, not a monologue. Why not share your thoughts in the comments section below? Perhaps you've had a positive experience with traditional investments, or maybe cryptocurrency has been your golden goose. Your insights could be invaluable to someone else. After all, knowledge is power, and sharing that power can only strengthen our collective understanding. Remember, the best investment decision is an informed one. So keep learning, keep discussing, and keep investing. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.